Synergy Green Industries Limited, and I will be moderating today's meeting. Before we begin, I would like to inform you that we will be recording this call, and in case any participants are not comfortable, you may feel free to drop off before we start the recordings. Thank you. So this is a disclaimer from the company's end. Shall we move to the next point? Yeah. So this is today's agenda. First, a brief introduction will be given of the organization, and then investor presentation will be given by Shreya ma'am, and after that Q&A session will be held. So I just would like to share the guidelines of the call. All the participants are kept on listen-only mode by the host. All the participants are requested not to record the call. Questions from the participants will be addressed in the Q&A session at the end of investor presentation by the management. During the Q&A session, we request you to introduce yourself with your name, organization, and then your question. Participants having multiple questions can email us on the email ID mentioned in the chat box, and management will make best possible efforts to respond within 7 days. Thank you. So, dear participants, welcome to the Q2 of the financial year 2025-26 earnings call and investor presentation of Synergy Green Industries Limited. Synergy Green Industries Limited is one of the India's leading state-of-art foundries producing SGI, gray iron, and steel casting for windmill turbines, wind gearbox, and general engineering industries in the weight range of 3 to 30 metric tons. Synergy Green has an installed capacity of 30,000 metric ton per annum and is in the process of upgrading 45,000 metric ton. The company houses best-in-class equipment, IT infrastructure, and quality testing facilities, and is a top supplier to major wind OEMs as well as leading gearbox players in the world. SGIL is a part of the Shirokar Group, which has diversified business interests over its 80-plus year history, spanning across sugar manufacturing, foundries, hospitality, and market research, among others. We have with us today Mr. V.S. Reddy, Executive Director. Mr. Reddy is a B.Tech in Mechanical Engineering, M.Tech in Manufacturing, and Executive MBA from IIM Bangalore. He has over 30 years of experience in manufacturing of large castings. Over his career, he has worked for corporates like L&T, ISGEC, and Simplex in establishing plants and managing businesses before joining Synergy Green from inception. Also, we are having with us Shreya Shirokar, AVP Commercial. Ms. Shreya has completed her MBA in Finance and having overall experience for more than 6 years. And myself, Nilesh Mankar, Company Secretary of Synergy Green Industries, having 13 years of experience in secretarial matters. Now, I would request Shreya Madam to give the highlights of Q2 earnings call. Over to you, ma'am.
Thank you, Nilesh, and good afternoon, everyone. I hope I'm audible.
Yes.
So I'll be walking you through the investor presentation for the first half of the FY26. I'll be going through the key highlights as well as business performance for the quarter. As we know that the world is betting on renewables, I'd like to draw our attention mainly to the industry that we majorly service, which is the wind industry. So global wind installations as well as Indian wind installations are doing well and are well on track to meet the 2030 as well as 2050 goals. In fact, at a global level, by 2030, wind installations are expected to exceed 2 terawatt. Now, this is a goal that has been set at across nations. However, there is still a gap in terms of the current installations versus what is expected of global installations. In order to close this gap, the installations must grow nearly threefold from right now, which shows the enormous opportunity that exists with the industry currently. At an India level, there are key domestic growth drivers that are bringing the Indian wind industry well on track to meet its 2030 goals as well. We have the RPOs, which is the Renewable Purchase Obligations, the Viksit Bharat Initiative, as well as certain changes in the tariffs for wind, which kind of help balance the solar generation by coupling it with wind and other renewable technologies. In the first half of the current year, for example, we've seen 3.56 gigawatt of onshore wind installations in India, which is a very promising number for the industry for years to come. Synergy Green specifically is diversified, and we cater to the broader castings market. We mainly service the large castings market, and if we look at the size of the castings market, just specifically for large castings in the wind industry, the demand for it is 1.5 million metric tons globally. However, when we look at it on a only purely large casting scale, which is non-wind as well, the demand is somewhere around 6 million metric tons. So this gives us a lot of opportunity in the future to look at non-wind traction as well from other industries other than wind. Just going over the company profile, Synergy Green currently has a foundry capacity of 30,000 metric tons, and we're in the process of upgrading to 45,000 metric tons per annum. We can produce single piece castings up to 30 metric tons, and we cater to all material grades. Majorly 90% goes to SG iron, but also a small portion is cast iron as well as steel. Looking at the other two key areas of focus for the company currently, we're setting up our machining facilities with a 20,000 tons per annum capacity. And I'll be speaking more about this in the further slides. As well as a renewable captive power project, we've set up 10 megawatts of solar plant to support our production. Besides this, we have a leadership in large-scale critical castings. We have state-of-the-art facilities, the best-in-class technology in terms of software, as well as integrated softwares across the company. Our quality standards are of the highest standards. We have quality certifications for ISO 9001, 14001, 18001, as well as we're certified for TPG audit, which is conducted by a US-based institute. We're also certified for ISO 27001 and 50001. This is besides the in-house NABL certified quality testing facilities we have, the team that we have, as well as the different machineries that we deploy. We're a trusted partner for wind and engineering castings. About 70% of our wind castings go to the wind customers. About 15% go to gearbox castings, again in the wind industry. And the balance of the castings are for non-wind castings. Some of the industries we're exposed to are mining, plastic injection, pumps, etc. We're trusted by 50% of the world's top 10 wind OEMs. In fact, we've newly onboarded Envision as well as Nordex, besides our existing customers, Vestas, Siemens Gamesa, GE Vernova. This is an addition to Senvion, Flender, ZF, which are gearbox players, Adani. In the non-wind segment, we have Terex, Ferromatic Milacron, Willow, as well as Mahindra, which are some of our customers in this space. I'll finally come to the main part of today's presentation, which is the business performance for the first half of the year. So our capacity utilization at the plant continues to be at peak levels, following peak levels which we'd achieved in FY25. And in the current year as well, we're operating at 89% of our total capacity production. Looking at the summary of our audited financial results for the first half of FY26, looking at the quarter-on-quarter between the second quarter for the current year as compared to the second quarter of the previous year, there has been a slight drop in revenue of 16.4% and also at a half-yearly level. The drop in revenue is more to do with scheduling of customers. So in the first half of the year, typically, we do see that there is a slower than expected offtake in the domestic wind industry. However, in the current year, we've seen a slightly skewed scheduling by our customers. And most of our revenue or sales are expected to come in the second half of the year. So this is the key reason for the drop in revenue. When we look at the PBDIT levels, however, the margins, we've managed to not only retain but slightly improve on our margins thanks to the stable business conditions as well as raw material prices. So for the quarter, we stand at 15.74%, and for the half year, we stand at 15.56%, which is a 143 basis points increase over the same half year in the previous financial year. Looking at the PBT as well as looking at the PBT for the quarter as well as the half year, as well as the profit after tax, there has been a drop in these numbers, again reflected because of the revenue drop that we've seen. At a balance sheet level, the capex cycle continues to go at, and I'll speak more about this in the further slides, as well as we'll just drawing your attention to the inventories. So the inventories that we've built are sort of reflecting our production in the first half of the year, which has been at peak levels. And we're building inventories for the second half of the year, where we're expecting most of our scheduling and most of our order booking to go through. So the second half of the year is where we'll be rolling out these inventories that we're building for in the second quarter. A brief overview of the financials. Looking at our various revenue segments and comparing the first half of FY26 with the first half of FY25, while there has been a 49.49% decrease in the half-yearly revenues, the revenue growth key drivers are direct exports, gearbox, as well as the non-wind segments. However, we did see the muted growth that is coming from wind domestic as well as OEM exports. These are the key reasons for the muted revenue growth. And as I mentioned, this is because of the scheduling. However, I'd like to call out that the full year outlook remains the same with a strong order book of around 20% growth. And this is backed by schedules from existing customers as well as additions that are coming in from the new product developments. Looking at the PBDIT, the margins have risen from 14.13% to 15.56% in the first half of FY26. And we continue to maintain that an overall increase of about 100 basis points is projected for FY26 over the previous year. Just looking at the capex plan and the status currently of the activities, the foundry expansion to 45,000 metric tons is well underway, and equipment commissioning is in progress right now. We're expecting this capacity to be online by the end of quarter 3 FY26. Looking at the captive renewable power, the 10 megawatts of solar project has been completed and is operational already as of October. The in-house machining, which was planned in two phases, the first phase is already, we're expecting it to be operational by Q3. In fact, just to call out, the two of the three machines that we expected to be operational have already been handed over to us and are operational. And we're expecting the second phase of machining to be operational by the fourth quarter of FY26. Looking at the FY25-26 performance outlook, major product development activities which were happening through the year for new customers such as Envision, Nordex, as well as some for Adani are well on track, and we're supporting a robust 20% order book outlook for FY26. Export revenues are also projected to remain stable, similar to the previous year, and PBDIT margins are expected to expand by over 100 basis points from over the previous year. So here we're expecting some partial contributions from our ongoing strategic investments. With this, I'll end the highlights of the presentation and hand it back to Nilesh, and then we can open the Q&A. Thank you.
Thank you, madam. So now I request all the participants to ready with their question. Ready, sir, shall we start the questions?
Yes, Nilesh. Good evening, everyone. I see Mr. Nitin Dharmawat sir has raised his hand. Sir, you unmute yourself and go ahead with your question, please.
Yeah, thank you for the opportunity, sir. Ready, sir, am I audible?
Yes, sir, you please go ahead.
Yes, sir. So thank you for this opportunity, and congratulations for improving the margin numbers as mentioned in the commentary. My question is, we have retained actually 20% guidance for the full year. Now, looking at the numbers, for achieving this 20% growth, we'll have to do almost 45% growth in the second half compared to the previous years. second half. So how much confident are we to achieve this 45%, and what are the risks involved while projecting this number?
There are two parts in it. One is order book point of view. We have already committed for the 20% the projection what we are given. That product development is more or less in the completion stage, and also customer schedules are aligned. The challenges part of it is, like as we discussed earlier, this is a brownfield project. We are doing expansion activities in the existing facility. So there are particularly right now the Q3 where we are standing, we are at the peak level of the project execution actually, because about 15 days back, we have completed the construction of the new building. We have moved out the fettling operation to the new building. Now we're going to start the activities in the existing the plant to install a third line, which is going on actually, So barring this production disturbance, I don't see any challenge actually, So still we are hoping, because one of the thing is, even though in the first half of the year, there seems to be a little bit of a revenue drop, but we have built a healthy inventory, which is aligned with the schedules in the Q3 and Q4. So we are carrying some advanced inventory with us. That is one supporting aspect. The second is with additional capacity, most probably it will come in the fourth quarter. Maybe it will be available for 2 months. We should be able to come closer to the guidance what we have given actually,
Got it, sir. My second question is related with capex only. So how much time will it take to get stabilized once the capex is completed? We are going to complete most of this in third and fourth quarter. So can you please elaborate that also? Will there be any delay in getting it stable for utilizing it completely?
Yeah, you rightly highlighted the thing. Basically, we are going through three aspects. One is the product development for the various new customers to align with our new capacity. Second is the project execution. Third part is the production ramp up. Actually, we have also started recruitment. Certain strength already were taken on board. This particularly this quarter and next quarter, I'm talking Q3 and Q4. There will be a lot of transformation in the organization. Actually, one is the capex cycle is at a peak. The second is manpower will be also gradually adding up to the peak levels, and the revenues will start coming maybe in the particularly Q4 actually, So overall, I don't see any significant this thing, but only thing what we are seeing is the next 2 months, that is in November and December, the shifting of the plant. So that is the only major part of it. If at all anything happens, see, there are two aspects. One is on the top line, and the second is on the bottom line. I don't see any problem on the bottom line. Even we may do whatever the guidance we are slightly better than, because we have maintained the first half itself is a good this thing, margin rate. And the top line part, maybe if at all, if it affects maybe below 5%, sure. That is how we are looking at actually, means the 20% guidance what we have seen, it may range between 15 to 20%, depending on how we manage the balance of the period actually,
So is there any chance of going beyond 20 also?
No, now actually order book is there. So only thing is this 3 months delay in our project is limiting that opportunity to go beyond that the 20% actually,
Got it. Got it. And my next question is about the tariff part. Since the tariff has now gone to 50%, so is there any impact on our margins? Is there any impact on customer demand because of the tariff factor that has come now?
In fact, that is another reason why there is a little bit of a drop in. Actually, ideally, I was looking at this present quarter, which has gone by, somewhere closer to 80 crores. This is what the expectation we had, but we ended up in close to 74 or something, which is about 5-6% below my expectation. One of the main reason is there were a lot of what you call the formalities, the documentation changes in the US because of the tariffs actually. So customers have asked us to fulfill the complete documentation before ensuring the shipment. So there were some shipment delays because of this. That is the first part of as far as the revenue in the first half is concerned. Regarding the tariffs, as of now, I am not seeing any significant reaction from the customers. As far as pricing is concerned, that is in line with like in earlier calls we discussed. We have plans to pass on certain benefits which are going to accrue during this expansion and increasing velocity. So those things only the passed on to the customer. Beyond that, I have not seen any of this thing. Means ultimately the whatever the revenue, the margin guidance we are given somewhere around 18% plus actually, that is the fully intact. In fact, interesting thing is Nordex, we have successfully completed the development. We are the only supplier from India as of today, which is a 5 megawatt and 6 megawatt platform. We are in almost on the final stage of discussion for exporting to US market from January to December in the next calendar year. Good numbers actually, maybe 50 crores plus kind of the revenues of what I'm expecting from this product alone actually. So it will be quite interesting. Either these customers are already anticipating this tariff is only a temporary, hence it is going to go away. They are going ahead with the schedules and planning and all those things are in line actually.
Okay. And my last question is about the raw material pricing. So how are we doing on that front? Is there any change on that? Power consumption is one of the key items for us. So is there any change on that front?
There are two aspects. As far as raw material is stable, we did not see any much problem from the raw material point of view. But power tariff, yes, you are right. There is an impact because recently in the month of July, MSCDCL have increased the power tariff by 10% actually. And apart from that, there is a big structural change in the power tariff itself. That means they are discouraging the solar and they are incentivizing more towards the wind. That means they've changed the zonal time period. And earlier we used to get a power tariff discount in the nights and the daytime charge to be higher. But now they exactly made it reverse, which is evening and the night period they're charging 25% penalty and daytime they're giving 25%. At the end of the day, power tariff point of view, yes, I know 10% there is an impact, which is equal to 1% of our 100 basis point the margin impact. But we were working upon optimizing our power cost because it's a brownfield expansion and with increase in production rate in the existing plant, we do expect certain optimization. Second thing is the impact is limited because now we're hedging the power with the solar. So these two things should help us in containing the cost of the power actually.
So my final observation with this power tariff structure, so is there, it may be positive also for our company because they are incentivizing more towards wind. So overall, there can be a different kind of demand coming in.
Actually, if you look at, you're exactly rightly pointed out, the PLF factor of wind goes up to 38-40%, as against solar is 17%. So everybody talks about per megawatt. So when you say the 20 gigawatt of solar is installed, so if wind is say 10 gigawatt, equivalent of energy generation, it is a 22.5 gigawatt or 25 gigawatt of wind actually, because the PLF factor of wind is much higher. That's one. Over and above, the recent tariff structure change, I believe the same Maharashtra state, whatever the policy they brought in, it will be followed by Gujarat, Maharashtra, or even Tamil Nadu. So with this, what is happening is now they are incentivizing the wind tariffs by 25% this thing incentive, and they are penalizing the solar. Because what has happened is this, I think I was quoting this in the couple of calls, that it cannot go away with only solar doing at a higher installation, wind is lagging actually, no?
I
That is
remember
exactly
that.
seen in the current year. This year already 3.25 gigawatt installations have been done. So probably we'll be crossing the highest ever installation in the current financial, it seems. Means we will be well above 6 gigawatt, seems to be installation in the current year actually, no? It's a positive thing for us actually, no? That's where we're expecting domestic market dramatically improve. The people are predicting, I was attending a couple of conference, it may cross 8 to 10 gigawatt annual installation should be easily able to catch up in the next 1 or 2 years actually, no?
Yeah. Great balance is required. That is what you had already been talking about.
Exactly. Yes, yes. Yeah.
Yeah. Thank you so much, sir, and
Thank you,
wishing
sir.
you best.
Yeah, thank you, sir. Mr. Subham Selvadia, can you please unmute yourself and go ahead with your question, please?
Good afternoon, sir. I am Shubham from Tikri Investments. Sir, my first question is, sir, what are the orders we have received during the current first half of the financial year, and what orders you are expecting to target for the whole financial years?
See, in the first half, last quarter, our investor note, we have given the complete details, but I will repeat again. Siemens Gamesa, the last year or so, the schedules were not in place. The new management has come in. That the supplies are going to start from December onwards. So that is one the new order book which started. The second is the Envision. We have completed the development. So they are also given a schedules, and we are likely to get a good purchases from the Envision. There is already forecast actually. Third thing is Nordex. We have also completed development of Nordex. So that also is going to come. This is as per the new customers are going. Regarding the existing customers, Vestas is a very stable customer. He keeps on giving the thing, barring a month going up and down, there will be a little bit of variation in the schedule. Barring that, there is no such kind of thing. Now, the big thing is the domestic OEMs, other two guys are Senvion and Adani actually, no? Generally, their trend is second half of the year, the lifting is much higher compared to the first half. This Senvian, if I look at the first half, almost very little actually. The second half, we see a good takeoff. So these are the various order book we have on the wind side. As far as gearbox,
Okay.
yes, we are doing really good. Flender has almost grown its business by 50%. Even ZF also equally going. In fact, first half of the year protected is mainly because of the good growth from the gearbox industry actually. Apart from this, there is also opportunity I have seen in the non-wind segments, particularly the power sector. Recently, I have come across the government has initiated a pulverizer, this thing, conventional coal to the tune of 80 gigawatt. So with this, L&T or even BHL, all these guys will be having a good amount of orders for the next 5 to 10 years, actually. So we are in discussions with both the and mainly to get some of the business in the non-wind segment as well, actually. These are the upcoming the business outlook, what I can say.
Okay, sir. So, sir, can you let me know the amount of order we have received during the first half of the financial year?
See, how it happens is it goes by the schedules actually, So, which we have already given the overall order book growth. I will not be able to spell out individual customer wise, but that is where we are mentioning a 20% increase in the order book growth for the current year. Actually, that's what we are. Of course, like as Vestas is flat, the new customers like Envision, Nordex, and this thing, Adani. So these are the new addition coming. They are in the range of 25-30 crores because we'll be doing it only in the last 3-4 months actually. So of course, next financial
Okay.
year, these numbers can go to the much bigger number because all the OEMs which I spoke, top three, for example, today's contest, if I look at Gamesa, Vestas, and even Envision, they're all the very big players. They have potential to buy each OEMs I'm talking about anywhere between 150 to 200 crores kind of the business opportunities. Looking at a synergies share of business actually, but we need to
Okay.
convert it, how much we'll be able to handle. That's the second part actually.
Okay. Okay, sir. So that's it from my side, sir.
Oh, thank you. May I request Mr. Kumar Saurav, please unmute yourself and go ahead with your question, please.
Yeah. Hello, Srini sir. So good to see now all the capacities are going live. Machining is also coming live. Sir, one question. When we see the H1 25 versus 26, the domestic wind is down from 44 crore to 12 crore. So was it by luck or was it by design given some preferences to, the export business where we got opportunity?
No, it is exactly not like that. See, there are two major aspects in this. First off, the domestic mainly driven by the Gamesa and Senvian. If I compare with the last year, Gamesa was in this thing, under assembly. Then thereafter, they have stopped the assembly of the turbines. So this year, still they have not started, which they are going to start in the Q3. So major drop is coming from the Gamesa, and the second customer is the Senvian. These are the two major contributors for the domestic demand actually. So for the current year, both of them, of course, Gamesa was not there because of management change and all. They are starting the assembly only in the Q3 or Q4. But Senvian is a little slow in offtake actually.
Got it. And sir, as we are still guiding to the 20% growth rate, which means anywhere the 30,000, we are almost at 90% capacity, which means for this growth, some out of that new 15,000 will be utilized. So maybe we will be at 20-25% utilization. So in 2 years, again, can we expect this additional 15,000 capacity to get consumed?
No, it should not take so much time. Most probably next year we are expecting to.
Then it means we have to again start preparing for the next round of expansion from 45 to 75.
You
So,
are
sir,
right.
currently, sir, for 15,000, we have spent 60 crore. I don't know how much was purely brownfield land cost and all. But for the next 30,000 expansion, what is the expected cost and how much you see coming from internal accruals and how much will be from debt? And are we going to do some kind of dilution? If you can, just give some idea on the financial planning.
See, we are not going to add a standalone 75,000. It will be built for a, say, 60,000, 50, 60,000 tons of a new facility. Only thing what we will be doing is the basic infrastructure will be built for a final terminal capacity, but we will be investing into the partial equipments. That is how we'll be maintaining the investments in two phases, wherein our first phase, we are trying to materialize up to 75,000 tons. This is the plan. Coming back to the total expansion to cross 100,000 tons of capacity, somewhere around 400 to 500 crores is the number what we are looking at. Means when I say the capacity, not just foundry, I'm balancing machining the way we initiate now, including the renewables. If I to take in combination, of course, we're not started doing a detailed financial working. We have a very rough estimates. We need to do detailed working. The biggest question in the second half of the second part of the capacity addition is what size of casting that we are going to do, because this we need to do a little bit of market investigation, because how the turbine sizes are going to be in the upcoming 3, 5 or 10 years kind of thing, means India where it is going to be the this the casting size. So that is what I see. Regarding the funding of this 400 to 500 crores, if I look at like the way we are done today, we are doing almost a 200 crores kind of capex. It is in the ratio of 25% internal accrual, 25% from the equity infusion, and 50% from borrowing. Means basically debt to equity of 1:1 kind of thing, actually. So we should be able to do in the next 18 months kind of thing, 100 crores kind of internal accrual, maybe similar kind of amount we raise from the market. We should be able to manage the capex. I don't see any problem, actually.
Great. And sir, one last question I have. We have some of the biggest clients internationally. Now, the kind of work which we are doing for them, what is the total opportunity per client, and how much of that opportunity we are serving? And is there a scope to, basically the revenue per client, whether it can go 2x, 3x, where is the opportunity and how much others are doing, if you can give some color on that?
See, if I look at someone like Vestas, Nordex and all, somewhere around 2000 crores is their demand. I'm talking casting also alone, actually, means
Also,
we'll be
get
yeah,
from types like us.
yeah. So out of 2000, maybe we will be, I'm talking about the global numbers. We may be having around 10% kind of the share of business globally, I'm talking about. So there are such kind of 4-5 clients are there. So 8 to 10,000 crores kind of the market exists for the customers, one who is already in there. But we need to align ourselves considering the market, whether it is a Europe market or US market, because they will be comparing with so many things, not just about the price or the capacity. There will be a logistic cost and tariffs. So many other things needs to be looked into. So based upon that, we'll be able to fetch the order book, actually. So considering the present, the clients what we have taken on board, first phase is like, for example, if I have to look at the 45,000 capacity, I don't see any challenge in utilizing the complete capacity, or it is slightly overflowing that capacity utilization, the kind of customers commitments what we're giving. So this also makes us to a little bit of alert in creating the next level capacity as early as possible, so that we can capture the upcoming demand, actually. And apart from this, as I mentioned, I do see a lot of opportunity on the non-wind segment as well. So we'll be gradually taking, because we are already taken with a big task of expansion. Once we complete, we'll look at the other aspects as well.
Got it. Thanks, sir, and wish you all the best.
Yeah, thank you. May I request Mr. Pratik to unmute yourself and go ahead with your question, please?
Sure. I'm audible, right?
Yes, please go ahead.
Yeah. Thanks for the opportunity. So I think my question is regarding the margins. So last few quarters you have highlighted that the margins would increase and will be sustainable. Just wanted to recheck on the factors that contributed, and how do you see that going ahead? You have shared guidance, but if you can just probably drill down a bit in terms of what is contributing to that. And sorry.
Yeah, please go ahead. Yeah, complete your question. I'll answer you.
Yeah. And my second question, second part to the question is, so the machining capex that goes live in the second half, how do you see the ramp up happening for that? And do you see any benefits coming from that?
Regarding the margins, if you have seen the investor note, mainly our exports growth has seen. It's almost, I think, 50% kind of the growth has happened in the first half of the year, actually. So that is where, because the dollar we consider for our estimate somewhere closer to 84, actually, but realization is around 88. So since the export business are there, that's why the margins are very healthy. And the second part is, of course, the raw material is stable. And third is, we have also utilized the capacity. That's where the inventory also contributes for the capacity utilization. So these are the three aspects helped us in the protecting the margin. But the upcoming the quarter, I'm talking Q3 is okay, and Q4 onwards, there are a lot of transformation is going to happen in this organization. One is new contracts are going to come in with maybe revised the prices, but at the same time with better efficiency. and the new this thing solar and other things contributions coming in, and also machining part actually, we have done a composite this thing. So based upon that, we see the current year we should be able to sustain the guidance what we are given on the 100 basis point margin expansions for the total year.
Okay, got it. That is helpful. And can you give some more color in the machining capex ramp
Yes.
up?
Yeah. Regarding the machining, we have already got the 4 machines on our shop floor, out of which 2 machines are commissioned. And in fact, yesterday only we started power on with the first component loaded. Development is going on. It is a new thing for us. We have a technical team to do it, but it may take some time, maybe a month or 2 before we should. Apart from that, we also need to obtain the approval from our customers. They go through the rigorous the audit process and other things. It may take a quarter to initiate, and once it is done, then we should be able to gradually ramp up actually, So
Okay.
I see some kind of contribution coming in the Q4. May not be very big depending on the how we handle the development activities. But for next year, for sure, we should have a good amount of contribution coming from the machining.
Got it. Okay, that's helpful. And can you quantify the benefit for next year from the machining capex in terms of margin contributions?
Hmm. See, earlier we were given guidance of around 3% is the total contribution coming. But I prefer to give a segmental wise the margin expansion because as I mentioned, there are so many things are happening. One is, for example, if I have to take, earlier we were doing machining in Chennai. Tomorrow we're going to do it in Kolhapur. With this, we are going to save on the logistic cost and also some benefits because of the in-house machining. And for the exports, we're planning to do it from here. So there is a what you call the composite mixture of the pricing, the benefits from the machining, optimization of the logistic cost, all those things. So considering all these aspects, we are given a guidance of the 5% or 6% kind of the margin expansion from the 14% level. So we are looking at somewhere around 18 to 20%. We should be able to reach the guidance actually.
Got it. Okay, that's helpful. Thank you.
Thank you. Mr. Pratik, can you please unmute yourself and go ahead? Yes, please.
Hey, hi, thank you, sir. So my question was, in this old side, can we do 60,000 tons? My understanding was we can expand from 45,000 to 60,000 tons in just old side, and for the next for the next ramp up we need to do a greenfield capex. Is my understanding right, sir?
Actually, we are making an attempt to stretch this existing 45,000 tons capacity. Per se, the equipments are all, you are right. We have installed for 60,000 tons, but we have to see how we will be able to manage the space. That is the only constraint I see. So it also depends on the what is the kind of product mix have. If I have favorable product mix, it may go beyond 45,000 tons. We need to see whether we can stretch 10-15% beyond the 45,000 tons. The first target is first get to the committed that 45,000 tons. We will also be looking at with some minor balancing because at least it will take 2 years to materialize the new capacity actually, Since we have made commitments to the existing customer, we need to stretch and utilize the capacity. That's what we are planning.
Got it. And so when we go for a greenfield capex, is there any minimum baseline foundry you need to set up to make it operational on cost efficient basis, or you can also ramp up in phases there at 15,000 ton, 25,000 tons?
No, given with the product mix, what we are looking in the bigger casting size, we will not prefer to do anything below 30,000 tons upfront actually, It doesn't make sense to start with a journey of 15,000 tons. But if you start, it will be too slow actually, Then it will take much longer time. So we prefer to go upfront, starting with 30, then ramp up with another 30,000 tons in the phase 2 actually,
Okay. Thank you. That was from my end.
Yeah, question. Mr. Rishabh,
Hi,
can you
sir.
unmute yourself and go ahead, please? Yes, please.
Sir, this quarter, our gross margins were somewhere around 69% versus generally for previous quarters around being 61-62%. Any specific reason why we saw that jump?
No, you should look at see how the accounting standard works is when there is a increase in inventory, that is a WIP, that is deducted from the raw material consumption. That's how it shows the gross margin actually. I prefer to do the output actually rather than deducting the increase in inventory from the raw material actually, because when I say WIP, that also consists of the power costs, the manpower costs, and a lot of other things actually, that straight away get deducted from the raw material. That is where the calculation get distorted. So I always look at calculating the total output, which is nothing but the revenue plus the change in the inventory. So add on the top line, then you will get the appropriate the contribution margins actually, no?
Got it. Okay, so I understand that over a period of next 3-4 quarters, this will again stabilize down to 61-62% of gross margins. The other one was on more strategic aspects. Are excited about us increasing our capacity to 45K. Beyond that, for greenfield expansion or even brownfield, have we started looking at additional land already? Do we have place in mind? What are our plans?
See, we do have a 25 acres land neighbor to our existing plot. That will be the ideal case scenario actually, no? We are in discussion with MIDC. In fact, we have put up a formal application for that the new parcel of land. There are some disputes in the existing owner of that land because they have not initiated the as per the committed to the MIDC. So that has to be surrendered to the MIDC and allocated to the new organization actually, no? That is what the process is going on. But we are also not pushing very hard because once we go there, then we have to arrange for the cash flow and other things on the other side actually. So, but we are exploring various opportunities to. So, because the beginning of the project is the land acquisition actually. Once the land is in place, the rest of the things can fall in line actually.
Right. And the third one is, sir, as you mentioned, like generally your share of wallet, share of business is around, say, 10% with some of these customers, and the China plus one theme plays out very well where people want to diversify. But as we move beyond, say, 15, 20, 25% share of business, then is there also a customer expectation of being as cost competitive to as China? And then do we then depend more rigorously on domestic wind demand from India?
See, the customer client based pricing is into three parts actually. No, one is the domestic clients. As far as domestic clients is concerned, always all our pricing is compared with the China actually. This is the first part. And in case of domestic, we get a advantage with Chinese competition. I'm talking about the logistic costs will come in our favor, and the customs duty. This will also come in our favor. So these two help us in protecting whatever the margins we have today. This is the first part. The second part, that is about the exports actually, direct exports. Direct exports is depend on the currency and tariff. These are the two things apart from the Chinese this thing. Then over and above the China plus one, what we're talking about. Because at some point of time, what I have seen is it's not a highly price sensitive within 1%, 2%. Of course, it's a big gap. Yes, there will be a problem. But today we are at a striking distance. I don't say we are competitive with China, but for sure we are at a striking distance with the closer, the manageable and the pricing side. So gradually it goes up. We do have plans. So how do we optimize the cost? Because that's one of the reason why we have invested into so much other things. Not just about capacities. Our focus is into the enhance our margin, also share with the customer actually. We are doing. And the last part, which is a little bit of the problematic thing, is the OEM exports. Actually, the OEM exports. What happens is, in that case, the this what you call basic customs duty is not applicable because they bring the casting under export obligation. So that 8%, 8.33%, the duty what advantage we have in case of domestic, that will be missing actually, But as of today, I have not seen any such kind of things that the domestic OEMs are trying to do. Always they keep on saying that your prices are not this thing, but still one good thing what happened in the last 6 months or 7 months, what I've seen is yuan has come in our favor. I think 5-6% slide in our INR against the yuan, which is favorable against for the Indian manufacturers. And the second thing, I don't know what also happened. The recently I understand the logistic costs from China to India or even for US have significantly gone up actually. Means I'm talking about earlier the 14-15% of the logistic cost. What I know is more than 35-40% is the logistic cost today. So there are a lot of dynamic factors: the tariffs, currency, logistic costs. These are the three key things going forward. How we will be able to manage the global business actually.
Right. No, thank you so much for the color, sir. All the very best to you and the team.
Mr. Mantri, can you please unmute yourself and go ahead with your question, please?
Yeah, good evening, sir. This is Khadija
Yeah.
Mantri. Yeah. So, my question is regarding the realization, whether a realization per ton per kg has gone down YOY. Because if we do the math for first half on 89% utilization, and if I take 6 months, then the realization is coming about 116, 120 per kg as compared to 140 per kg, which used to be earlier. So if you can just clarify.
See, when it is in the inventory, it will not be at a selling price, it will be at a cost price actually, no? So then the machining cost and other things need to be added up. So you also need to see, when I say utilization, at what stage that inventory is standing. The major part of the valuation happens at the production of the casting. Then thereafter, it goes to the various processing, including the fitting, even though there is no significant the material addition, but there will be a labor and other things. The third part is the machining service addition. So we should not be comparing directly with the capacity utilization versus the realization actually. That may not happen. The coming back to the specification, there is no significant drop in the realization. Today also still it stands at 140 rupees per kg, closer to, I am talking the number actually, no?
Okay, sir. And sir, can you please explain the export obligation point that you discussed in the previous question?
No, I did not explain the obligation. The point what I was trying to the mention is how the market is playing around. When I split it into three parts, that is the domestic market, the OEM export, and third thing is the direct exports. I was mentioning about the export obligation for the OEM exports. Means one of the OEM like Vestas or Nordex or anybody, they're doing the assembly in India. And if the castings take from Synergy locally, compared with the Chinese prices, we miss the opportunity of a basic customs duty for imported casting from China, because they will bring this casting from China with the export obligation actually, no, means that will be waived from attracting the basic customs. That is where it creates more cost pressure for the OEM exports. That's what I was trying to mention actually.
Okay, sir. Understood. Thank you so much.
Thank you. May I request Mr. Jignesh Vaidya, please go ahead with your question.
Sir, as you mentioned that you are also planning to discuss with BL and L&T for the thermal business. So once we have this capacity in place, around 70 to 75% of the revenues will be still with the wind segment, and only balance will be the other two segments, right?
Yes, see, in fact, we're talking about three parts. So even though gearbox would be part of the wind, but still we're considering as a separate the segment because we get the global exposure actually, you know. Now, coming back to the purpose of looking at the beyond the existing customers like mining, the pump industry, or the plastic injection, we see good opportunity in the power sector actually, you know, because of the kind of the demand what is upcoming in the country. So particularly these big giants are sitting with a huge orders. What I understand, I had a couple of meetings with these guys, and they are sitting with a 10 years kind of the order book actually, you know. Because government of India has given a mandate for additional 80 gigawatt conventional the power addition as well. So if you are able to start, because again, I'm not just looking at this 45,000 ton capacity only, because it will take some time. I'm not going to get 100% share of business from the whatever the upcoming new business, you know. If you show your presence, start with small way, and when we have additional capacity, so you will have non-wind segment parallelly going along with the wind segment. That's the thought process.
Okay. So if I am able to understand, since in this first half, the gearbox and non-wind was a higher percentage of revenues apart from the wind. So the margin, there would be 100, 200 basis points difference because of that.
No, I mentioned earlier also, the margin is because of the exports business. There is a growth in export business as well, and the better dollar realization actually, no?
Okay, understood.
Yeah.
Thank
Sure.
you.
Thank you. Mr. Rajiv, can you unmute yourself and go ahead with the question?
Yeah, hi. So talking about the margins, you said you expected to improve by 100 basis points. So how far do you see the margins shaping up over the next 2-3 years? Do you think you can improve beyond that as well?
Yes, we have already given a guidance. See, when baseline we are taken somewhere around 12-14%. I'm talking 2 years onwards, we are giving this guidance of margin expansion, targeting between 18 to 20% actually, no? We are already at a 15% plus level. It was not part of the planned this thing with the strategic investments in the renewables or the machining. Still, they are yet to contribute in our margins. The primarily the current expansion in the margin is mainly because of the currency actually. The exports business growing up, and the dollar is coming in favor compared to the INR actually. This is the main reason. But with the machining and solar coming in next year, we are looking at 18% plus kind of the margins.
So you think you'll be able to do it by next year itself, right?
Yes, I'm hoping for the next year. Yes, 18% kind of range.
And
Maybe a half percent here and there. It depends on how we mature the whole. See, the margin is dependent on so many other things: the raw material and the strategic investments and the capacity utilization. So these are the various things. Yes, you're right. So we should be able to come closer to the next year.
okay, and talking about the expansion, so what do you think the cost would be of the entire project if you go beyond the current capacity expansion, like 75,000 and 100,000 metric tons?
Yeah, this I've already put it in the multiple forums. Somewhere around 400, 500 crores is the number we're looking at. That may consist of maybe 250 to 300 crores in the foundry and maybe 150 crores for the machining and 80 to 100 crores on the renewables. It's a very rough kind of the projections, but we need to do the detailed working.
Okay, so this does not include the land acquisition cost, right?
This includes the land. When I say 250 crores, means that includes the land as well. This includes the
That includes land. Okay. And can you talk about the new product launch that you're talking about this year? Can
land.
you throw some light on that?
See, we added three new clients or the products in the current financial year. The major is the Envison. We have already completed the development. Nordex, yes, we have already completed the development. And the third is the Adani. We have received the 3.3 megawatt the platform. Earlier, Adani we were doing only smaller part, that is a bearing housing, which was weighing around 7-8 tons. The hub and mainframe, which are the bigger parts, we were not able to do it because weight of those castings were above 35 tons, but our maximum capability was only 30 tons. So till date, Adani was importing from China, so we were not able to do it. But now Adani has launched the smaller turbine, that is a 3.3 megawatt, in line with the rest of the OEMs. So that is where we got the development order from the Adani as well. So these are the three new clients which we added, and we developed the products at a various stage of development actually.
Thank you, sir.
You're welcome. Mr. Kunal, can you unmute yourself and go ahead?
Yeah, hi, sir. Very good evening on and congrats on the set of numbers. Uh, so my question is from FY20 till FY25, we we have had the similar capacity of 30,000 tons, but in the next 5 years, we are going for a 3x, more than 3x capacity. So, sir, can you maybe give a little broader perspective on what has changed in this 5 years that makes Synergy Green triple this capacity in the next uh 3 years, three to
See,
four
up
years?
to 2021, 22, the Indian wind industry was stagnant actually. So it was in the range of 1-2 gigawatt and all. It's a combination of things growing from what you call the domestic market from say 1-2 gigawatt to 8 to 10 gigawatts. Means the domestic market itself has grown 3 to 4 folds actually. Of course, our total revenues are not just from the domestic market, but that is the growth. Second is the export market that is coming from the China plus one this thing strategy. So a lot of OEMs have started looking at beyond China. So that is where we are getting export opportunities, not just from the direct exports to the OEMs. The demand is also coming from the OEM exports. Means many of the OEMs like Nordex or Vestas, they are assembling the turbine in India and exporting to the international market. So there is a overall growth in the action in India for the wind industry. That is where we are. And with organic growth from the other segments, so particularly gearbox. In fact, gearbox, it was the demand was there for quite a long period. We were not able to do it because of the machining and other things. Since customer taken a lot of initiatives in installing the machining facilities in India, so that is where our capacity is growing today. Because of the machining constraints, we are not able to execute a big number. So the gearbox industry also grown, and we also focused a little bit on the non-wind. So we are trying to see all segmental growth. That is where the growth contribution is coming from actually. In fact, if I
So
have to make a one point, barring 1 year, of course, our growth may not be every year at 30-40% kind of thing, but always we have grown. Barring 1 year, if I take from the inception of this company, whatever the growth, yes, we have a consistent growth actually. Sometimes 20%, sometimes 5%, 3%, whatever is there. So we have maintained the consistent growth. But now growth is accelerating because things are improving actually.
No, so it's commendable that we are trying to increase the capacity by 3x. So that means that you all are seeing immense demand come in to India. And so on the machining side, right now we are going for 20,000 metric tons capacity for in-house. But as our foundry capacity is increasing to 45,000 and then 75,000. So machining will again, we need to outsource most of it. So then do you feel that the margins that you are guiding for, I think 17 to 18% will be able to
Uh,
sustain?
Yeah, see, today we are trying to maintain around 50-60% in-house machining actually, So when we go for additional capacity, when I say capex, we are also thinking of along with machining actually, So I don't see any the significant the moving away from the margin guidance what we're giving today.
Also, this capacity increase is including machining as well. So machining also will increase sequentially along
You
with
are
this capacity.
Yeah,
And
we
sir,
are
on
guiding somewhere around 50-60% in-house machining. Balance 30-40%, 40% will be outsourcing.
okay, and will the incremental capex to increase the machining will be similar to as of now, or will it be lesser? Like currently, I
Uh,
think for
See, right now we are put at 20,000 tons machining capacity, but actually basic infrastructure like building, crane, land, and other basic infrastructure we are done for a 30,000 tons. So next to 10,000 tons will not be very significant,
difficult, yeah.
but beyond 30,000 tons, again I need to build a fresh infrastructure actually.
Okay, and sir, how will this be funded? I mean, I'm seeing the cash flow. You said I think our 100 crore will be funded internally. But I think a lot of so what is the working capital if you can work on that? Because I'm just trying to figure out if working capital constraint will, restrict our funds to be diverted to capex.
No, the
So
good part is our working capital cycle is low actually, I think we are it's in somewhere around 45 days kind of the working capital cycle what we are having. Because primarily, first part on the receivable front, we are able to discount our receivables and we are not allowing it to go beyond 30 days actually. That's a significant
okay,
portion of that. Because even though we offer 60 or 90 days of credit time, otherwise at a 50 crores per month level, 150 crores goes in the receivable alone. But we are able to factor all the invoices and that's where we are managing the capital. The second thing is we also get around 60 to 90 days kind of credit from our suppliers. And the major, the investment in the working capital goes into the inventory actually, we need to see how we manage the going forward. Our thought process is to bring down this working capital cycle with in-house machining coming in place. We should be able to reduce our lead time. So with that, we're trying to optimize it further actually, So I don't see much capital allocation on the working capital side. So whatever the fund generation is happening, yes, there may be some small addition, but majority is going towards the capex side actually.
okay. And so was one last question. So when we sign contracts with, Nordex or Adani or Vestas, so how long are these contracts? Do they book capacities for 3-4 years, or is it like a fixed price, or then how is the contract? If you can give a gist
See,
of it.
our business working model is one is we call it as a long-term purchase agreement actually, means
Okay.
we do have a agreement for a relationship between both the organization actually. This is the first part. And of course, so formally that gets renewed every 3 years, depending on the customer to customer. The second thing is we will get annual forecast that is for the next to 52 weeks. This is the second phase. And we do have a informal capacity discussions for the upcoming 2 years. Means in general, we have 3 years kind of the forecast from the customers. So when I talk, I want to push it from say 45,000 tons, 100,000 tons, means I'm in discussion with the customers to get additional the business. So we're trying to manage our capacities in line with our commitments we're doing for example, somebody like Vestas or Nordex and all, we're committing some numbers to 2028 or 29 kind of thing. Actually, So we're trying to align according to the discussions, how it progress and our capacity creation. So always our capex was first securing the business from the customer, then go ahead with the capex. This is how we've done it. Even if you look at today, we have done such a big capex from 30 to 45 machining addition and all. In fact, we secured the order even before completing our project. Actually, this is how we could able to manage in this industry. Actually.
And so, who is the closest competitor in the Indian market?
See, in India, there are two the major the competitors. So one is coming from the SE Force, is the Suzlon's subsidiary company.
Yeah, Suzlon.
Yeah, Suzlon subsidiary company. Second is the Better, that is a German company. It's basically a Vestas own foundry. They had a couple of foundries in Europe, one foundry in China, and in 2022 they built up a foundry in Chennai as well. You know, so these are the two major customers. Then rest of the things come from China.
Okay, thank you so much, sir, on this broad perspective.
You're most welcome. I don't see any further questions. I'm handing over back to Nilesh. Nilesh, can you please
Yes,
come?
sir.
Yeah.
Thank you. So I would thank all the investors for participating to this session and making interactive. On behalf of entire Synergy Green Management team, we thank all the investor and analyst community for joining today's call. Thank you so much. We can stop the recordings.